Thank you for watching Resource Talks. It is the end of the week, and the Flying Dutch list maker is sitting on the other end of this call. So that must mean this is Junior Mining Talks for the 51st week of the year. We're nearly through. And after disappointing me last week, Luke has actually made a list this week, and a long one at that, too. It's almost as if he's trying to compensate for something, but I can live with that because we're talking about the junior market in its entirety. Because as I like saying, this is the hobby that loses you money most of the time and isn't all that fun to begin with. I think I might have stolen that from Luke, to be fair, though. But sometimes investing in juniors is also kind of like gambling on horse races. Only in a lot of the cases, the horses haven't even been born yet. And actually, most of them never will get born. Half of the ones who will actually get born, they never get to run in the race itself. Half of the other half of the rest might run a little bit and then get tired and come up with all sorts of excuses on why they can't finish the race and why they actually want to go participate in a swimming race or something like that. And a small fraction of them finishes the race, but not always in the form of a horse. Sometimes they're a cow at the finish line. It's a complicated sector, but whatever happens, your wallet is going to get diluted in the end. So needless to say, I'm well caffeinated. Some may say I'm too caffeinated. And I'm looking forward to classifying the different categories of racehorses or juniors in this case and figuring out how to maybe lose less money on each one and what the pitfalls are, what the opportunities are, how some of these juniors can actually go from being unborn to being born and then getting strong and then actually finishing the race. So again, Luke has made a list, and Luke, what is it's a long list. I don't even know how to introduce it. What have you made?
Well, the list is not even that long. It's just 10 rows. I think I've shown way longer list, but it's really to categorize companies in 10 different categories. And I didn't even know that these would become 10. I always think in market cap ranges, not because market cap is the most important. Companies dilute enough that market cap could become irrelevant over time. The market cap grows, but the price is going down is a typical example, I think.
Mm.
But to value a company, like where are they right now in terms of valuation, and where do I see it if a number of things go right? I think it's important to think in those market caps. The risk it really is. I mean, companies can really grow within a month from a million to 20 million by just doing a big deal for a new project, settle some debts and do a financing, and do a number of deals, and suddenly it goes from 1 to 20, and the share price didn't even move. So that's the risk. Companies can completely transform, indeed, like you said, from a shell without anything to a company with projects and management teams and financings and everything behind them. Um, but still, that would just make it a new company, in my opinion, and it still makes it possible to put them in one of those categories. And why is that easy? I think it makes it easier to. I mean, most companies do not make money and actually lose money. Almost all of them, even in close to the $1 billion range, companies still lose money because they spend money to progress the project. So how to compare them? You cannot really look at profitability or any metrics that other sectors, I would say, where you can really make a difference as a company. Here is really adding value on a project level and trying to come up with creative ways to sell ultimately that project, or perhaps bring it in production. But that's a different story.
Mm.
And I started with making these 10 ranges without really thinking of going to 10. And when I these ranges make sense to me because you sort of categorize similar companies, and it led to 10 companies. I came up with some odd names to give all categories a name, and that's how it started. This list, a new list was born.
I don't think that's too hard for you at this point. I think maybe they get born every day, or multiple a day probably. The interesting part with now that I'm thinking about, that's what I do. I talk and then I think. But now that I'm thinking about what I said about the horse races, is that finishing the line is essentially getting into production. That's when you're no longer a junior, I suppose. But you can be a junior producer, but you're not a junior in the sense that I would call it a junior. And really only one of the 1,000 or 2,000, 3,000, whatever the numbers are. I don't think anyone's really done that specific science to see the data there, but one in 3,000 companies ever finish the race, essentially, to get into production. That doesn't mean you can't make money on the unborn horses, which is the unique part of the junior sphere. And to a point that you make, welcome to dilution 101. I mean, sometimes you can have a company crossing the market cap lines, going from what you call bare bones junior to a micro junior to a nano explorer, early stage junior, which kind of takes it from 1 million to 2 million market cap. And if financings were not done properly, you could end up not making money on the stock, even if you bought early on, because through dilution, the market cap's higher, the share price is not higher. I don't know how often that happens, but it definitely happens. And that actually might be a good way to approach this list is per category. Maybe we can talk about what matters most per category, because maybe in the very small caps, the bare bone juniors, what you call is the range of $0 to $1 million. What matters most? Is that the team that matters most in the first place? And then when we go to the catalyst juniors, is that when geology matters most? So maybe you can talk about them that way.
Yeah, there are not many companies in category 10 that will become successful without some very dramatic changes to the company, meaning a financing bigger than the company size or a complete change of management team, or you will almost never find. I cannot even think of one company that went from 10 to 1 without some extreme changes, like a big financing by a strategic investor or a completely new project that's 10 times as big as the company. That really means that it's just a shell. The company didn't mean much other than it being cleaned up or ready for to become a new vehicle. But I think there are actually companies that went from, I'm not sure 9, but for sure 8, maybe 9 as well, from 9 to 1, without becoming a different company. It still involves strategic investment and all kinds of things. One that comes to mind is Serious Resources that made nickel. They made a nickel discovery in 2012, and they were actually, I think, at the time of the discovery, a 5 million Aussie dollar company, and they became a billion plus company. I think even close to 2 billion, but something between a billion and 2 billion, I think. And it was all done. This complete move was done by the discovery. They of course financed along the way. They became a 100-bagger, and that's one of the very rare cases where a company makes a discovery being so small, $5 million, and then going to a market cap of 500 million within a year and becoming a 100-bagger. And then it became, of course, a plus $1 billion company, but by dilution. So it never really went much further than 100-bagger. But of course, a 100-bagger is very unique, and at some point there's a limit to how far you can grow. But that was one that really went from 9 or 8 to 1 in a sort of a organic manner.
Yeah, sounds like they were serious about it. I'm sorry, I'm gonna take that back. I'll cut it out. People should not hear that joke. No, I'm kidding, of course. But what matters then in that case? I mean, you're saying they went from what you're saying here. So going from 9 or 8 to 1 is 9 and 10. So 10 is the bare bones juniors, and then 1 what you have is frontier juniors. That's your 1 billion to 2 billion market cap. What does it take? I mean, I listened to someone like Sean Rusin on the Crash Lab podcast this week, and I thought it was a very well executed podcast, actually, and Sean was great in it. So I'd recommend people listen to that as well. But he talked about buying an asset out of receivership for $80,000 and then selling it for over $4 billion, right? You hear these success stories. They happen, once in a blue moon. I suppose you don't often hear them. They're the biggest stories, but and that was a holistic thing. When you ask him what's the one secret to that success, he's not able to answer that, right? Because it's not a team, it's not a financing, it's not the geology, it's not the execution, it's everything. It's everything combined, but different things at a different stage. So if I'm looking at a junior, $0 to $1 million market cap, I should seek professional psychological help, first of all, to begin with. But then what else should I be looking at? Like, what matters in this range?
Well, I think the $80,000 number, of course, was the acquisition of the property. I'm just looking at it right now. Cisco was a 4-cent company and went to, well, $16 company. That's impressive. But yeah, if you look below $1 million, you are almost always speculating on this shell, because it's almost always a shell. I mean, it could be a project, but the project isn't that meaningful at all. A shell buying a new property, or perhaps first getting a new management team and then buying a new property. That's what you're speculating on below a million. And speculating below a million is really tricky. I mean, it really depends on the deal. If you're buying 4 cent stock, I mean, it could go to a cent and roll it back again. I mean, you could lose 70% of your money without anything changing really. Sometimes, but again, it's a very difficult category to really talk about much. I think the category when you really can find some value as an investor, typically is 8 or 9. That's where a lot of people speculate. And
Mm.
even of these two categories, most companies will fail. They have, I mean, I looked at how much cash they really have. Almost none of them has more than, only 50 of them have $2 million in working capital out of these 600 and what is it, 670 companies. So almost all of them are close to broke and have big plans for next year. So they are going to finance again. They will have trouble raising money and they have to give away presents like warrants to finance themselves, and they do it again and again, and the thing becomes unfinanceable, and they will roll it back again. But in this category, of course, nice stories are born. But still, I think most bigger discoveries or bigger events come from companies that are already in that, let's just say, 8 million to 25, $30 million stage. And sometimes it's problematic because as an investor, you dream about getting in at $5 million and getting out at $1 billion or something. But most companies have a number of years until they are that 10 or 20 or $30 million company, and from that point on, things start to happen. A new investor comes in, confidence grows, price goes up, financings are getting done, more work is getting done, and a discovery is made. So in a lot of cases, you see a discovery, for example, only happens after the stock going from 10 to 30 or 40 million, and then the announcement comes, and then you want to get in at 60 million. It's difficult to know which company is going to do that, and it's way easier to just look at the news when it happens, but you have to accept that the thing already went from category 9 to category 7 or 6 the moment something impressive happens. So that's often the problem you have to deal with. The price is often up already when that amazing news release comes. There's often years of work done at that point, and you have to decide, is it still worth my money and my time to invest in a company like this? But it's still, I mean, I also invest in category 9 every now and then, in category 10. Well, mostly 8 or 9. I mean, $3 to $4 million in a bear market. Sometimes you find some nice companies there with still a good project, with still a good management team, not a lot of attention, otherwise it wouldn't be trading there. And with potential, if things are done right, which is difficult at that share price level in most cases, in that market cap level, to really grow and become a 3 or 5 bagger organically. And organically, I mean not buying a property or a project 5 times as big and pay in shares and become that $15 million company, really growing from 3 million to 15 million by doing one financing and doing some good work.
Mm.
That's what I call organic.
I think I'm gonna make a list now off this conversation. Then you tell me if that's right or wrong. But I think with the in category 10, 0 to $1 million juniors, it has to be a unique situation of sorts. And the word says it, unique. I mean, it's not likely that most people will come across a situation that goes from category 10 to category 7 or 6 even in their lifetimes. And as my mom told me when I met my wife at first, and I told her, like, hey, I met a wonderful girl and she's great and beautiful and smart and funny and all these things. And she's like, oh, if she was too good, she wouldn't have come to you. And so that's my relationship with my mom then. But she's right. Like if something is too unique, it typically doesn't, like 0 to $1 million. It typically is not going to end up in front of a retail audience. That's typically when insiders would be getting positioned, solving, getting assets out of receivership, solving permitting issues, small stuff, basically kind of reviving the company, which is already going to put it in at least category 9, depending on how strong the network effect behind it is, probably putting it in category 8, which is 3 to 10 million market cap. But so essentially, what matters most in category 10 that I'm going to make here in my list would be um, the the management. So the network behind the company, management as in the network of the management itself, and the plan. So what is the plan for revival? So I have here management and plan for revival for category 10. Does that make sense?
Yes, but in a lot of cases, you're not going to find an amazing management team below $1 million market cap. So you would have to see signs that somebody's taking care of this company, sort of managing it until the real management team comes in. And it's still very difficult because there's not enough public information to really predict those things.
Hmm.
I would, if you look at this list I mean, it was not my idea to talk too much about category 10, but I can imagine you are attracted to it, which is probably the problem in the first place. But if you have companies below a million, you can already, I mean, if you don't know much about the company and you just want to screen, take every company out of this list with debt more than or liabilities more than $500,000 or $1 million. Well, sometimes actually those are interesting because then they settle the debt and suddenly you get a control person, a couple of new investors or backers. Sometimes the debt is actually part of the plan, in my opinion. So there's debt, salaries or whatever, or loans that need to be paid back, and then they pay it back in shares, and suddenly it's a $2 or $3 or $4 million company with a couple of new big investors. So sometimes that could actually be a positioning strategy, and that's why I'm saying you don't often see people actually working in a company like this, not building up debt, not building up liabilities, and doing good stuff. Then you really go to category 9 in most cases. So you really find shells, a lot of companies with a ticker with an H behind it, or with an the other one is, I think, a P, capital. What is the name again? Capital pools, and you have H companies are companies without a project that is qualified. So you really talk about a real shell, but you also have companies without those HMPs that are still real companies, so to say, but with not much. I mean, look at those salaries. People still take a fairly big salary, in my opinion, out of these companies, even though there's almost nothing left to take. And but you see the burn rate going down because there's not much to take anymore. So it really you don't find big names typically in these companies, but sometimes you can recognize by the people, and if you look at their network again, that they are potentially managing a company for something new to come in. But again, then they are buying a property and it goes from $1 million company to a $5 million company just to do the deal. And then they are in category 8 or 9 anyways.
Yeah.
So anything below $1 million is not really below $1 million because there will be a deal that will bring it above 3 million or 4 million the moment the deal is done.
Yeah, and again, if you have that network, like if it's part of a group, a group of companies that you might have, then it's typically not going to stay below $1 million. Again, it jumps the category. Now, jumping category, category 9, that's your $1 to $3 million company. What matters most there is assets. So there's the presence of an asset matters most to begin with. Like there has to be an asset, there has to be a claim or an option, earn an agreement or something like that. That's something that it has to be there by the very least. I think overhead matters. You brought it up too, but I think overhead matters a lot in that specific categories because it is not easy to like what's the cheapest you could run a public company on each year? What do you think? Like 400 grand, like everything if it's not spending too much on salaries and stuff like that, but just being listed and all the costs and expenses, what would that be? 400 grand?
Well, I have got one of these same overviews with the ecosystem, the junior mining ecosystem, where I looked at cash flow from operations, and it also includes revenue if in most cases, there's no revenue. And these micro juniors, they have cash flows of minus 114,000 a year, a quarter. Sorry. So I think $400,000 is $500,000 more or less is accurate. Maybe there's one or two companies, a few companies that can do it for $300,000 a year. But not many. The average is 114,000 of outflowing cash every quarter.
Per quarter?
Even it's,
Okay.
yeah. So the number you see here on the slide with the green and red cash flow from operations theme. That's when I mean the bare bone juniors, as I called them, $64,000 a quarter going out, and micro juniors, $114,000 per quarter going out. And of course, the higher the market cap goes, the activities go up, or the salaries go up, and more money will disappear.
I don't think you've sent me those slides, by the way. I was just going off of what you had written on LinkedIn.
Okay.
But we can you can send it to me. I'll overlay it on the video later. But yeah, okay. So or send it to me right now, and then we can talk through them. But so yes, okay. Overhead matters here a lot. So the presence of an asset and overhead, like you don't want it because it's just really hard to finance in this range. I think 1 to 3 million, and then we go to the 3 to 10 million, which is I think the part where I'm most attracted to. Well, being at least a little bit of a degen myself, I am attracted to those sub 1 million companies, but they rarely work out. So that it's almost like a non-starter. But 3 to 10 million is, I think, the category that I'm most attracted in, and it's partly your fault. But that's when more things start mattering, like jurisdiction is going to start mattering here too. Cash is going to start matter. Cash is going to matter here as to what work can they do, how long can they survive for? So runway, stuff like that. But jurisdiction, where are they? Can work be done here? Like, can it be permitted? Do they have the cash? Do they have the plan? And all these things, they kind of stack up on each other, right? So if you, with 0 to 1 million, we said a team and the plan matters. 1 to 3 million, we say, overhead and the presence of an asset matters, but also still the team and plan. So they kind of stack up on each other with each category. And then category 8, jurisdiction matters, permits, cash matters. And geology is starting to matter, but I think it's really going to matter more in category 7. What else matters here in category 8?
Yeah, I think that these are the first companies typically where you see and we talked about a PowerPoint curve a couple of weeks ago, jokingly, but where you see PowerPoint presentations being updated regularly, meaning they have something to update about to the investment public. And sometimes you see these if you see very nice presentations, you sometimes have the impression, okay, this is going to be a promote. What I try to look for is really teams that think about their thesis and want to convey, like, this is what we're trying to look for and this is how we present it to you, because they will never warn you like, hey, this is a really risky company, we only work 4 months a year, we want your money, but the likelihood of you making money is of course very small, and but we understand that you will always get a pitch, and the pitch will always be, look at this amazing opportunity, you can be part of it if you want to. So that's the type of story you will get in 3 to 10 million typically. And actually, a lot of companies, even the big stories, the Snowlines. Well, the Snowline didn't even make. I think Snowline started somewhere in 7 or 6. So this was a well-respected team that was able to raise money with pretty good investors early on, and that's why they listed and immediately got a market cap, or they raised money at a market cap of between 10 and 20, I think, and they started trading above 20 million. And if you have my slides, you would see that from day one, it never really touched the nano explorer or micro junior category. And that's sometimes the problem. If you're really too focused on these tiny companies, then you may miss out on the companies where it actually happens. And who cares if you buy a 30 million market cap company, if that's where the opportunity lies, and that's where you can find your 10 bagger. Sometimes the opportunity there is, of course, much better, but you get drawn to these very small ones, dreaming about going from 3 or 5 million to 500 million. That's, of course, the risk you're taking anyways, but you're increasing the risk by looking into these very small companies. For several reasons, they are higher risk because indeed they will run out of money, will have to raise again at a low level, print a lot of shares, and only when, in most cases, in my opinion, when companies really move from a new category to a much bigger category, it's either because of a new discovery or it's because of financing becomes easier, meaning new investors, strategic investors, new backers. That's when companies really change for a longer period of time from one category to the other. Otherwise, it's very difficult because you remain, you get value for a team, you get value for a property, and you get value for value market cap for promotion. And promotion is in most cases temporary, unless that promotion leads to a real event. And 3 to 10 million, I think most companies, well, most companies still fail anyways. But in this category, I think 80 to 90% will never really, in the long run, provide you a return.
Well, I actually think that most of the money is made when you buy a company that is trading between 3 to 10 million, but has the characteristics of something that should be trading at 10 to 20 million. So let's say the category 7 is what you call early stage juniors. What you need there is geology starts to matter a lot. Geological team starts to matter a lot. Target generation, the process, is it a systematic approach to how they generate targets? And all these things. Just generally, I would put a stamp on, say, like geology, and of course the geological team on top of that. And again, it stacks up all the other things like financing capability of the team and everything that we said before. It stacks up. But if you have all these checks, but it trades at 3 to 10 million, so it's trading as a nano explorer, but it actually has the bones of an early stage junior. Then yeah, then that's basically where all the money is made. That's kind of how I think about it. What do you think?
Yeah, I mean, one example I took with me this week is Hanan Metals, or I'm not sure if I pronounced that right, but it's also a team that's partly behind Southern Cross that made the discovery. It's I would say, an experienced team. I guess that they have some big shareholders, maybe shareholders that they have in Southern Cross that they also got into Hanan Metals, because if you
Mm.
look at the news this year, in my opinion, most companies wouldn't get $90 million of market cap because of this. I'm not trying to talk the story down, just because it's still early stage work, IP surveys and soil sampling, and but they have defined a prospective. They have defined a target, a big target that they are going to drill very soon in Peru. And because of this change from maybe being close to a zero to having this amazing target, the company went from $20 million to $90 million, maybe even touched $100 million for a while, a week ago, in 1 year, less than a year. That means it went from category 7, early stage juniors, to category 5, promising explorers, and almost went into category 4 without a drill hole. The risk here, of course, is if you invest right now, believing it right now, it's probably in front of your eyes, all these nice pictures of the target, and you get, tempted to buy some of it. If those drill holes, the first couple of drill holes, are not going to hit the target, of course, this thing will come down rapidly. But it probably got this valuation for 2 reasons. One, because the target is very promising, and 2, I think, because they probably have some good backers behind it. I don't even know for sure, but it's very difficult to imagine that you go from 20 million to 100 million just because the target, based on IP surveys and earlier stage stuff, goes from to 100 million. So I wouldn't be surprised that a person like Pierre Lassonde, who's also in Southern Cross, is involved in the story, or maybe other investors of his caliber that make it a bit easier to move a number of categories, just because you have more buying in the market, more of a network, being interested. These people have big networks. They talk about the story. A lot of people want to be involved in it as well, so they buy the stock. Maybe their friends are buying the stock, so you get more natural buying, and the stock gets more appreciations for the same result. And maybe this project sitting in a less organized company, it could trade at 20 million. So it's not just the project. In this case, it's likely a combination of investors, project, management team that led from this 20 million to 100 million. In my opinion, a risky point to get in. But probably I don't even know enough about it. It's for me very, I screen these things, and for me right now, there's no interest to buy it at this level, because a lot will depend on the first drill holes, and I don't want to take that risk. I rather pay 200 million if the drill hole is amazing than 100 million, waiting for the first drill hole to confirm the thesis. But this is a good example where a company organically went from category, category 7 to almost 4.
Hmm. What I just said, by the way, works both ways. I think most of the money is made in again, being in one category of market cap, but actually possessing the characteristics of having to be in another category. And for some reason, but you also have to know the reason, like why if it has the bones, if it's a nano explorer, so 3 to 10, but it has the bones of a, which is the argument that is often being made, but it has the bones to be a catalyst junior, so 20 to 50. Why isn't it? That's kind of a simplistic question, simplistic way of looking at it, but it's, you have to have an answer to it. But that's where most of the money is made. But then on the other side, that's also where most of the money is lost. Like if a company is trading as a promising explorer 50 to 100, but it really only has the bones of an early stage junior, and then results start disappointing because if you want to be a promising explorer, so 50 to 100 million, I think that's where you already have to have all the other things that stack up, but you also have to actually have proof of concept, at least for the geological thesis. You have to have the grades, you have to have the widths, there has to be some infrastructure, there has to be more financing muscle, because you need financing muscle along the way, but then you need a lot more financing muscle because $5 million financings are not enough anymore. You got to start thinking about the 10, and not everyone can get those done. And so, yeah, point being, you have to pay attention to what characteristics does the junior have and where does it trade. And it is the disconnect between market cap and characteristics that most of the money is made or lost, I think.
Yeah, and one of the examples that you were involved in, moving from 3.8 million, maybe even a little bit less, Nano Explorer number 8 to which Avali to 65 million, which is then 5 promising explorers. I mean, don't go too hard on the names, but just a couple of names that I thought of together with ChatGPT, thinking about right names for every category. But Avali went from, I mean, you picked it up at 3 million because, prospective ground, pretty good team, pretty good share structure, and you waited for a year, and they drilled a couple of good holes. And I mean, I think it fits in the catalyst category, catalyst juniors or whatever I called it, catalyst juniors, because the catalyst moved it from 4 or 5 million to, for a while, 65 million, but right now it's back in the 20 to 50 million range. Of course, not all companies from 20 to 50 million went there because of a catalyst, but I had to look, for names. Ramp Metal is a similar one. It was a very small company, drilled a surprising drill hole out of the blue almost, and moved from being a $5-6 million company to being a $25 million something company. Providence Gold recently drilled a couple of holes. It was a project drilled, by many companies. They sort of revisited all the data, drilled a few holes, and made a surprise, really an impressive drill hole, and the stock went from 5 million to 20 to 50 million. So on purpose, I took these 3 companies because they moved into this category because of a catalyst, meaning a drill hole. And sometimes these, like I said, sometimes these companies move from category to category because they are growing in market cap, issuing paper, but not really growing the share price. That's a possibility too, but that is slower. I mean, typically these companies issue paper and paper again, and then the market cap grows, the share price remains flat, but there's enough progress for the market cap to keep growing, which is not necessarily helpful to an investor, but it gives a bit of scale and perhaps makes financing easier.
Yeah. And I am still in Awali Resources. I have de-risked my position early on. Same with Ramp Metals. I think you brought me into it. So fair disclaimer, non-honest confession. There's an obvious bias here. Those 2 positions are de-risked for me. It's very curious to me to see them in the same category. I see them as wildly different companies as a whole. I see them as being at a different stage. So that's where I think that the delta comes from. I think that's where the profit comes from the delta. They are technically in the same stage when you think about market caps, but I don't see them being. I don't see the assets geologically being at the same stage at all. So yeah, that's one point. What else?
Well, I think Ramp is. I mean, Avali is better understood. The project has seen more exploration. The belt is better understood. Ramp was looking for a geophysical target, a nickel target, drilled and by surprise drilled really high gold grades, and so high that it be really outstanding. And the stock, jumped Eric's plot came in, which is helpful. And it landed some, at a valuation of 25 million or whatever it's trading at right now, which is, I think, fair. I mean, it has the potential. I mean, if they can hit this a number of times, I shouldn't say on a consistent basis, but if they can hit these holes a couple of times, you can, of course, grow ounces really rapidly. But maybe they will never hit it again. And then they're currently overvalued, perhaps.
Mhm.
So Avali has a number of targets, has a number of discoveries. Not a discovery yet where they trade at 100 million or more, but has many irons in the fire. So I agree that Avali is way more advanced than Ramp. But if Ramp can replicate this drill hole 100 meters away from the last drill hole, then Ramp will be above 100 million very quickly, and
Hmm.
maybe Awali won't. So it's not like better or worse. It's just different in terms of understanding the project and how much work has been done and the number of targets. But that doesn't mean that Ramp cannot grow like crazy if they can repeat that previous hole. It's just higher risk, in my opinion, than Awali.
Yeah, because it's less developed, there's less work being done on it, as you say. So there's that. Also, fair disclaimer, non-confession. Awali Resources sometimes pays for interviews. I suppose that adds another layer of bias. People should know that. Ramp doesn't, but again, I think you own shares of Ramp too, Luke. So there's that. But okay, so that's your promising explorers that we had gotten to. I think again, geology matters a whole lot here. Stacking up on everything that we've said, and then you go into what you call expanding juniors, so 100 to 250 million. Um, it's everything stacking up, but what else is stacking up here? I kind of have it hard to understand what besides better geology. So again, promising explorer, you need geology. Expanding juniors, you need better geology. Or what would you say matters here most?
Well, in this category, I would only own shares if I think it really has the potential to go to $1 billion. This is already a market cap level where still most companies are not making any money. They spend money to drill holes in the ground and hope for a good outcome. And of course, I'm making it a little bit negative right now, but if a company really has a good discovery, and Lavras is one of the lists, one of the charts I took with me, that company went from, I didn't buy it at this level, I bought it lower. But that company went from $16 million, $10 million even, I think, to 100 million plus because of a new discovery. And if you really believe this could be a snowline type company, which is not impossible, I'm not comparing the geology here, but more the size potential or grade potential, then of course Lavras is still a buy at 100 million. Uh, Nobody knows what Lavras is going to find, but they have a good discovery. I think Tom mentioned it's maybe 1 million ounces or 1.5 million ounces, or maybe two. I don't know. It has a number of ounces, at least 1 million, based on the previous resource. But it is a real discovery. It is fairly big. I think they have found some of the limitations of the current discovery, and they're now looking for new discoveries in that same belt. Can they make another one like this? Well, then it could become a $500 million company. So I think if you invest in this range, you want to have something that backs it up, not just a dream or a promote or a target that has never been drilled, and potential. And that's the only way I can be fairly comfortable in this range. Or it needs to be a royalty company, but I don't think we are talking about that category today, really. Um, Canoland has a royalty, just one, that could be worth 100 million alone, but that's a different topic. Um, so if you really look at one project in one company, then that project, since I don't invest much in production stories, for me has to be already a discovery that backs up the valuation with potential for more. Lavras is probably a good example of this. And I took that chart with me because that's another story that went from 10, 15 million to well over 100 million. Combination of discovery and, again, strategic investors, people that really buy in the market and give it even more credibility and give investors comfort that there's people caring about the company.
But I mean, then essentially it goes back to either more discoveries or big growth of the discovery, like discovering a new zone that kind of changes the game plan for a company to go from a promising explorer to an expanding junior, so 100 to 250. So new more discoveries, or the discovery of a new zone or something on the current discovery that is a game changer that doubles the potential or something like that. Would that be fair?
Yeah, and I think Snowline is, I mean, I don't want to necessarily compare Snowline. Well, I'm doing it, so let's not say no. I mean, they made a discovery. I think the really big drill hole, the visuals were made around 100 million market cap. So they already did have a couple of few holes, good holes, and then they became better and better. The intercepts became wider, and the grades went up, and it organically grew from 100 million to almost a billion by showing the market more information. And Lavras is an example that could do that. I'm not saying they will, but they have many targets. It's not just if they drill one target, it fails, that the story is over. They have many targets that they're drilling. They already have a discovery with 1 million or 2 ounces. If everything goes wrong here, I'm not trying to make a case for Lavras, but it's just making a case of why would you buy $100 million junior. I think if in Lavras' case, if everything goes wrong, it could still sell this project to a Kinross or a company active in Brazil willing to build a mine of 1.5 or 2 million ounces. Maybe that's too small for Kinross, but it's potentially already big enough to build a mine. And they have such a big land package, so many targets, that there's enough potential. A failed hole will not bring it back to 50 million, in my opinion. A successful hole could bring it to 300 million, and another successful hole could bring it to 500 million. The Snowline model, let's just say. So that's the potential. There's always risk, but in Lavra's case, you have insiders buying a lot of stock, them doing a lot of drilling. They have a discovery behind them. In those type of cases, and again, I'm not trying to sell Lavras to your audience, but in those type of cases, I would be willing to invest in a $100 million to $250 million company, because I think the value is fair and there is upside. In many cases as well, when I see 100 million, like in Hanan's case, they didn't drill a hole yet. It's all potential. There's nothing really backing it up. Perhaps a team. Sometimes investing in a team like ATEX with Pierre Lassonde in it traded well above, in my opinions, a fair market cap, but it stayed there because you have the right people backing it, and people are loyal to them. They buy stock, they own stock, they don't necessarily sell it. So you can keep a market cap too high for a while with the right people in it. Hanan, just by their progress, 100 million is a lot. But if they make a big porphyry discovery, I mean, it could become a 10 bagger again. Not trying to predict, it's just risk reward. And in Hanan's case, I think it's quite, the market cap is quite rich right now, and they need a good result, in my opinion, to really keep that valuation or go higher. And that, in my opinion, is more tricky than a Lavras case, for example.
Where do partnerships come in, or strategic investments, if you will? Because I feel like it's gotta have to be somewhere around here. Like if you go from an expanding junior, which is 100 to 250 market cap, into a successful, what you call a successful junior, 250 to 500, can you do that without having sold 20% of the business to a major, or having done an asset level deal or something? Or is that where that comes in?
Well, I think 20% to a major is probably stupid, because it would limit your possibilities to get other people to be interested in your story. Well, stupid is maybe not. It's always easy to comment on the sidelines, but it's better not to have one major at 20% and no other major there. But I think it's almost unheard of to go from 5 or 10 or 20 million to more than 200 million or 300 million without having some sort of strategic investor. Meaning it could be a corporate, but it could also be a wealthy investor like Ross Beatty or Lundin's, or perhaps a fund, maybe even a Crescat. But like some sort of strategic investor that noticed your progress and invests in you. And it's almost like kicking in an open door, because it's very logical. I mean, if you have an event and it makes you grow from 20 to 500 million, or even from 20 to 80 million, you are doing something right. Either you're attracting the right investors, or you're doing the right work, and that work attracts the investor. But you will get bigger names, and they sort of de-risk the story a little bit to smaller investors, because they think, hey, the Lundins are there, or hey, this guy is there. Now I'm comfortable buying this thing as well. So almost in any case going from a small market cap to a big market cap. Also, if that market cap is not even organic growth, if a company of $50 million suddenly finds a way to buy a $200 million project by having, then you also need financing, and you also get people with big names involved, because otherwise you cannot get a project like that. If you can buy a really big project, the people selling it to you want to have a level of certainty that you can finance those things, and logically, and bigger investors are involved to get you that big project. So it's kind of an easy thing to say that growing to that market cap always involves some sort of strategic investor, and ideally, such an investor finds that company early so that you, as a retail investor, can piggyback. You see Lundin stepping into Sanu Gold 2 weeks ago, and the stock going from 8 cents or 6 cents to 20 cents just because they came in. Nothing else changed in the meantime. But they identified the opportunity, and that makes other people comfortable to also buy the same stock, even at a higher level.
Yeah. Yeah, that makes sense. That's what I would have thought. With successful juniors, that the thing that stacks up is partnerships, attracting big money, attracting new investors, new important investors. And we've done episodes on that, as in, thinking what they bring to the table, and attracting the right party really is what matters if you're going to keep it up. And there's two more categories: accomplished juniors and frontier juniors. Accomplished, 500 million to a billion. Is this where we're talking about sort of the second part of the Lassonde curve? Like, this is your PEA stage companies, because I don't think it's typical for a non-feasibility junior to have that market cap here. But what else stacks up here?
I think the best companies in this range, at least the ones that I consider the best, do not always necessarily have a lot of studies out there yet. Think of Snowline and think of Vizsla. Well, Vizsla has studies out. At this point, they are working on some sort of study for sure. And this is a range that I am unfortunately not often involved in. One, because I'm not often buying companies in this range. The upside in most cases is not enough for me. I'm a high risk taker. The ones that I owned, Vizsla Silver, I owned it very early, and I am looking at this industry for so long that I see so many risks that I can almost never keep a stock from 5 or 10 or 20 million level to all the way 800 million. I think the only way I could do it is when developments are going so rapidly, like at Snowline, where they have suddenly a very big drill hole, and they get improving and improving and improving. In Snowline, you could have a concern with the jurisdiction. It's far away from the infrastructure they will need one day. So that could be a concern, but on the deposit side, I think it's being de-risked very rapidly. And if it goes fast enough and you realize that you're sitting on one of the best discoveries in the last 10 years, well, that could give you the confidence to keep the stock for so long. But in many cases, I take money off the table when it really gets into that. And that's why we had some sort of criticism, or not even criticism, on founders metals. It has nothing to do with the success or the future success of founders. It's just that I think a lot of things can still go wrong when you are, going through the 100 million category and then going towards the 300 million category. If there's still a lot of uncertainty, and in founders' case, in my opinion, it's not a Snowline deposit yet, it almost means that you need to find a deposit like that size, or that's, Vizsla is smaller but very high grade. You need to have something very consistent. And if at 300 or 400 million, it's not obvious enough to me, then I wouldn't own it. I mean, you saw it with Amex Gold, good discovery. They got 300 or 400 million dollar of market valuation, but it didn't really reach the Snowline type quality, as far as I could consider it. And then you really have to hope for them proving it up, and they brought out a resource estimate, and then the thing came down to 100 million again. So I think you have a lot to prove when you go towards the 500 million mark. And I think only the really, really, really good ones, the Reunions and the Snowlines and the Vizslas, of course, easy to mention them because they are already successful. Those are, I could potentially see myself holding them all the way to a billion. But in my case, I often sell too early, if you can call it that.
I think what also matters, so proof is actually a good word to put here. What matters in this category is proof. Like, you have to prove that what you have works. essentially, or that it works, meaning that it's economical. And then with the frontier juniors, what matters a lot to me at that stage, I don't at all typically get involved at that stage. Um, but what matters to me there would be a final investment decision. So that now we're going into, a third party that signs off on it and says, like, we're going to give them a lot of money, hundreds of millions or tens of millions of dollars to develop this thing because we know it's work. It could be a weak in precious metals. It could be one of the financiers that like the banks and whatnot. So that's what matters the most there. I don't think I have too much to say about frontier juniors. What you call frontier juniors is 1 billion to 2 billion market cap. That's not something I have the bandwidth for at all.
Yeah, you also have to look at your competitive advantage. Like Great Bear, I mean, if you own it for a long time and you really believed in the deposit and into the team, then you think, okay, somebody will buy this. This is too good not to be taken over. Will somebody pay 1.5 billion for it? For Rand's case, they are building it. They could be taken over at some point. Will likely happen at some point. So you could stay for that event to happen. But if you get a bad market, the stock could come down and they sell it at the current high, for example. So it's really how much risk do you want to take? And competitive advantage point of view, how can I compete with an investor that has 10 earth scientists sitting there and doing all the evaluation on the deposit, on the metallurgy, on the drill holes, on the jurisdiction? I mean, there's so many risks in this business. How can I compete with bigger teams doing all that work? So when there's only little information available and little interest, that's when I can stand out because I'm only one of the 5 or one of the 10 people or maybe one of the 20 people really investigating that company in detail. And then having a better understanding than the majority is not very difficult because there's almost nobody looking into it. So it's way easier to be the best investor or the best informed investor in one particular company that is in that lower range than one of the better informed investors in that top range. Access to the team, I mean, those teams do not really care about me much. So why would they talk to me for 3 or 4 hours explaining all the different things to me? The smaller companies, could have an interest explaining me because I may buy enough stock that could be of interest to the share price or in general to the company, being a bigger investor to them, or it could give. I'm not really a promotional type. I'm not selling my services really from that point of view, but people talking about it in a positive way helps a story as well. So there's 2 ways for a junior company to benefit from somebody being interested in you. I mean, a person buying your stock in the market, good for the share price, buying the financing, good for getting money in the bank, or the person talking about it and good for other investors getting interest. So for smaller companies, there's a real interest to talk to you. For the bigger companies like Foran or Caliber, why would they spend 3 or 4 hours on me every month or every 2 months? So I think in many ways, there's no good reason for me to be in one or two, unless I think I am part of a unique situation where I own the stock for a while and it's just the best thing in the last 5 years and it's going to be sold to a big company. Maybe then that last 30% that you can get there, or 50%, or perhaps more, is worth the risk.
I think that covers them all. I think that's the 10 categories. I also know you have to go. We can keep talking though, if there's anything you want to, what else did you want to talk about when it comes down to these categories?
Oh, we could do a marathon episode where we are going to talk for 24 hours and see if we can get a world record talking about junior mining stocks. That would be a lot of fun.
Let's do that. Let's do that next time. But thank you so much for doing this. This was a lot of fun.
All right. Thank you.